So you have heard, don't buy a property based on emotions. Rather, it should always be based on your return on investments. Do not use emotions. So stay tuned, because that is what I want to discuss in this video. How do you calculate a return on investment, and what is a return on investment? So stay tuned. Hello everyone, my name is Abbas Pradhan. I'm a property investor and I'm an owner of an estate agency called 10x Rising. On this channel, I share with you the insight of what I go through on a day-to-day basis that may help you on your property journey. So if you enjoyed the content, please hit the like button, subscribe, and hit the notification bell so you do not miss the next videos. So the first question that I do get asked sometimes is that what is a good ROI on a buy-to-let? What is an ROI on a buy-to-let? I can't tell you what a return on investment is on a buy-to-let, because you need to determine how much cash you're investing and what your profit is. Based on that, you will know what your ROI is. Working out your return on investments on a property that you're considering to buy is so crucial that you should not bypass this step at all. This is what will determine whether this property that you're going to be buying is good or it's not good, whether you should stay away from it, or if it is something you need to snatch and get hold of before you lose it through someone else buying it. You should never confuse your ROI based on your gross rental yield. That gross yield is nothing. Rather, you need to be focusing it on based on your actual annual profit. So let's go through an example what an actual ROI is and how does it actually work. So first thing you need to be actually aware of is what's your actual annual profit. So this is where you take your gross annual rental income and then you subtract it with all the other expenses that you anticipate to have in buying this property. So what kind of expenses would you have on your buy-to-let? First one, you will have your letting agency fee. Generally, they vary between 8 to 10%. So you need to consider that. Have it into a spreadsheet. Let's go through it together now. Okay, we're going to do an example. You do it on your Excel sheet on a piece of paper, and I'll do it on my calculator, and we can go through it together. All right. The first expense you're going to have is your letting agency fee. That's going to be deducted from your gross rental yield. Then you're going to have any maintenance. Because obviously if there's someone living in there, definitely there is going to be maintenance work. Then you're going to have void period. Of course, if it's a rental property, a tenant will have a fixed period on his tenancy. They may move in for 2 years, move out after. So that time that it takes to find in a new tenant, that's considered void period, because your property is empty. You're not getting any rent. So you want to be very sophisticated with your spreadsheet. You don't want to put in fake numbers to get yourself excited to buy a deal which is going to let you down later on. You want to be realistic about what you're getting into. Put in all the realistic figures in there. And hey, if you save and you don't get any void periods, then that's a bonus for you. But don't go jumping in there with all the excitement, putting in numbers which are not true, thinking, hey, this sounds like a good deal, and I'm not putting in any void period because maybe I won't have any. Don't fool yourself. So put in your void period in there. So if it's a HMO, put 20%. If it's not a HMO, put 10%. Okay? And then you've got your mortgage payments. So you obviously, if you're buying a property via mortgage, you're going to have your either the amount you pay back, your principal amount, or you're just paying your interest payments. So you want to factor that in, because that's the rate you will have gotten from your lender already. You know what the current rate is, so you want to put that in as well. Okay? So let's go through an example now. You've made your spreadsheet. You know all these expenses will be there. Let's say you found a property, a block of 4 flats for £200,000. Okay, £200,000 is what the block of 4 flats. Now this deal is a very realistic deal. It's based on what I've just seen on the market a couple of weeks ago in Liverpool. So let's say it's costing you £200,000 to buy this property. I'm not going to consider the stamp duty costs and the solicitor costs and the conveyancing costs and all the other costs that are anticipated to buy this property, but you put that into your spreadsheet, whatever cost you're going to have into buying this property, because this video is going to teach you how to calculate your return on investment. Okay, so £200,000 is what it costs to buy this property. You're going to use mortgage on it, so 75-25. 75% is loan to value, is what the lender is going to lend you to buy the property. So what is 75% of £200,000? That should be 150,000, correct? So 200,000 times 0.75, 150,000 pounds. That is what the lender is going to pay you to buy the property, and they're going to have first charge. you're going to be putting in 50 grand. So that's your deposit, 50,000 pounds. Now, let's just say in this block of 4 flats, each flat is renting at 500 pounds. So 500 times 4, that's 2,000 a month, that's 24,000 pounds a year. Now, that's your gross rental income, 24 grand. Now you want to put down all your expenses that you're going to have into owning this property. What was the first fee we discussed? The letting agency fee. Let's say they charge you 10%, that is 2,400 pounds. Then you've got your maintenance fee, because you want to keep the property uptight, into good repair condition. You don't want it to deteriorate and leave it high and dry and then things get worse, because trust me, repair work which is ignored and deferred always gets worse. If you care about your money and your hard-earned income, do not let it deteriorate. So put 10% aside for your maintenance fee. Sometimes, yes, you may need more, but the purpose of this calculation, 10% is a reasonable amount. So 2,400 pounds into your maintenance again. Then keep 10% aside for your void periods. Again, back to it. If the property is not empty for a long period of time and you do not face any void period, then that's a bonus for you. But just accommodate for it for worst case scenarios so that you do not have to give up your property. Okay? So 2,400, that's 10%. Put it aside into your expenses. And your annual mortgage payment based on interest rates only, considering you're only paying interest only, is 4%. Okay, so if you're paying 4%, that's 0.04 times 150,000, that is 6,000 pounds. So let's add all this up. If you're adding 6,000 plus the 2,400 plus the 2,400 plus the 2,400, this will equal to 13,200 pounds. So if I remove the 24,000 pounds minus all these expenses, you will be left with 10,800 pounds. 10,800 is what you're getting cash profit every year. So you've removed all your expenses, letting agency, maintenance, void period, mortgage payments, all the other costs. If it's a lease property, you want to add in your service charge payments as well. Add in all your costs there. For the sake of this calculation, your profit at the end of the year is 10,800. So 10,800, how much did you invest in the property? 50 grand, isn't it? So 50,000 pounds, that is, so divide it and then multiply by 100. So if you just divided 10,800 divided by 50,000, that's 0.216. Convert it into a percentage times 100, that's 21.6%. So 21.6% is what your return on capital employed is. Quite good, isn't it? Let's compare it to if you just bought it cash and cash, alright? So we will know whether it's actually worth it to buy cash and cash or to use mortgage, just for the purpose of the video. So the purchase price stays the same, 200,000 pounds, letting agency fees still stay, void periods fee still stays, and the repair fee still stays. We're not including leasehold because this is a freehold property we're talking about. So 7,200 is the cost of owning this property, maintaining it. Okay, it's a business. Your tenant is your customer, your property is your product. So you're maintaining that service, a relationship for the tenant to keep paying you on time. So 7,200 is what you make, is you spending minus the 24 grand that your gross income is, which is equal to 16,800. What was the purchase price again? 200,000 pounds, isn't it? So 16,800 divided by 200,000 pounds, which is equal to 0.084. Multiplied by 100 to convert it into percentage, that's 8.4%. So if you use cash and cash, you're making 8.4% on your cash, whereas if you use mortgage, you're making 21.6%. You've more than doubled your income that you could make, isn't it? So the most crucial thing is that you want to know that are you making good money on your investment? This 8.4 or whether it's 21.6, you want it to always be positive. The higher it is, the more money you make on your investment. So it's quite common sense, it's easy. So the reason people use this, and everyone uses it, is because you want to compare it to all the other types of investments there are out there, right? You could be investing in stocks, so you could be starting a business, you could be buying a franchise from McDonald's, who also promise you, by the way, 20 to 25% return on your investment. So you want to understand what is worth it, what is not worth it. What if I find a flat in city center which is only giving me 3% instead of 8.4 cash and cash? Is that worth it? Or would I rather buy property in Liverpool which is giving me 8.4% cash and cash and mortgage 21.6? Because on cash and cash, if it was giving me 4%, if I use a mortgage on it, it's probably going to be 8 or 9%. You want to consider all these things to know which one is a good deal, which one's not a good deal. That's the basics, fundamental reason why people use this formula. Annual profit divide by how much money you've invested. Back to the initial example where your profit was 10,800, where you divided it by 50,000 pounds and you were making 21.6%. Let's just say again 10,800, but your initial investment was not 50 grand, because let's just say 50 grand is what you used to buy the property. You had your stamp duty costs, your legal fees, your surveyor's fees, and maybe you had some you had a sourcer to pay, all in extra 10 grand. So 50,000 turns into 60,000. So you're spending 50,000, which is a deposit, and 10 grand the other amounts that you had to pay to close the deal. So divide by 60,000 pounds, that is equal to 18%, which is still good, isn't it? So you want to factor this in. Now you want to compare it. Is this better to perhaps owning stocks or parking your money into crypto, which you hope will 10x or 20x? You want to factor all these in. Which one's riskier? Which one is safer? Which one is a stable market? When you factor all these things, understand that property prices tend to appreciate with the demand and supply. The UK housing market has massive shortage of housing in the UK. Automatically, because of the shortage of housing, demand for rental properties tend to go up. Demand for buying properties goes up over time. So while factoring all this in, think about it long term. Rather than putting your money into pension and perhaps hoping for a return at the end of it and paying taxes on that, let's look at it if you bought a property. Today, the rent is £500 per flat, so you're making 24 grand, that's gross income. What if each flat was giving you 650? So 650 times 4, that is 2,600 a month. Times 12, that's 31,200 pounds. Same way, before you were making 24 grand gross, now you're making 31,200 gross over time. I'm saying maybe let's say 7 years later. Okay, so now you're making 31,200 pounds. Same way, you're going to have 10% letting agency fee, 10% maintenance fee, 10% void periods, all in, and you're going to have your mortgage interest payments as we discussed initially, which was at 4%, you were paying 6,000 pounds. So all in, after deducting 31,200, which is your gross income minus all these expenses, you are left with 15,840 pounds. Now, 15,840 pounds, what was your initial investment? 50,000 pounds, wasn't it? So 15,840 divided by 50,000, that is now giving you 31.68%. 31.68%. That means you're going to have all your initial capital invested back within 3 years. Times 100, 31.6 years. Yeah, 3 years. That's all it's going to take. 3 point something years. You're going to have all your money back so you can invest it back. The other plus point is that you have put in 50,000 pounds to buy a block of 4 flats, correct? Let's say over 10 years, the property price appreciated and is now valued at 400,000 pounds. It's doubled over time. So now what you could do is sell off the property, for example. You take back your 50k you invested, 150k back to the lender, you've made 200,000 pounds profit. You can retire, enjoy your life. Either you could do that or you could refinance. Go back to the lender and say, hey, remember that property I bought initially 10 years ago, which was valued at 200,000 pounds? Today, I want to revalue it. Perhaps they revalue it, it comes to 400,000 pounds. You want to refinance it now. So at 75% loan to value again, because it's a residential property, you will get back 300k, 300,000 pounds. You give back the lender, the initial lender, their 150 which they borrowed you, 50k which was what you initially invested to buy the property. You're left with 100,000 pounds. You can use the same process, 100,000 pounds, now buy another property worth 200k and wait again. And you can keep doing that cycle. Either you could do that or buy rundown properties, refurbish and refinance. So either way, the capital appreciation that you will have through buying a property will be so significant compared to what you will get in the bank. How much will you get in the bank? Generally, today's market, if you keep your money in a savings account and fix it for 5 years, you might just get 3% or 3.5%. That's it. Whereas if you buy a property using mortgage, you're already getting like 21% right away anyway. So why would you keep your cash in the bank to deteriorate with the inflation going up? You'd rather take that money and put it into property. However, one thing you should understand that is these numbers that we're talking about, this is before you pay your income tax. So you're going to have your tax that you're going to have to pay for, but this will be also tax deducted. I cannot tell you exactly how now, but you will also have some write-offs based on the expenses you will have, and some which will not be because maybe they might be assets that you're buying, so they're not a write-off, and that's why we can't calculate how much income tax you'll be paying now. But yes, you will have income tax to pay, but yet generally it is much better than what you're getting with your cash in the bank. So to wrap up, do not make decisions on buying a property based on emotions. Always have a spreadsheet. Use return on investments to decide which property to go for, which one to stay away from. So I hope this very basic video has been useful for you on how to calculate your return on investment. If you found this video useful, please do let me know. If you want me to do more videos like this, perhaps to do property analysis, whatever, because I go through a lot of properties on a day-to-day basis for my investors to look at what properties we should buy. So if you think that's going to be useful for you, do let me know. I'm more than happy to make another weekly video to show exactly what type of videos I am underwriting, which ones we buy, which ones we avoid. And if that's useful for you, do let me know. Otherwise, I will see you in the next video.